Hi, Peter. Welcome back, buddy.
Thanks for having me.
All right. So, we have some data here. Why don't we start with first, let me ask you what's top of mind for you we haven't talked in a while. I have your blog up here. What's your key takeaway from and what you're focused on going into the debt ceiling and what happened with banks? And to me, what's top of mind besides being squeezed on the short side of NASDAQ is the move that we're getting in yields, Peter. I don't think people are expecting yields to head back to 390. Technically it looks like it could happen. Do you think we're headed back up there?
Well, a couple things. When you look at the economic data, in my opinion, it's doing nothing but soften. I listened to a lot of company conference calls, stocks we own, stocks we don't own, but just to get a sense of obviously the micro, but certainly the macro. And challenging macroeconomic conditions, I think I heard in every single call that I listened to. And there's a clear, broad economic slowdown going on. And
is that what Copper's saying, Peter?
I believe so. When you hear a retailer saying people are buying more food, beauty, and drugstore products and less of everything else, that tells you a lot about the state of the consumer. Capital spending slowing because profit growth is slowing. So to me, there's a broad slowdown. Whether it's a recession or not, it certainly feels like we're at best not growing, and at worst about to head to an economic downturn. The interesting thing about rates is that in the face of that, we're seeing obviously this uptick in interest rates, and we're seeing, and not just here, but even today in Asia, we saw a rise in rates. In Europe, yields are up about 10 basis points across the board. So we have this sort of stickiness in the level of interest rates. Now, granted, a lot of it has to do with monetary policy and pushing up short rates, but even long rates, the 10-year in the U.S. now north of 360. Yeah. Now, there's obviously a lot of noise around the debt ceiling, which it is noise. It'll get raised. But we also have to think that when it does get raised, so the Treasury general account, which is basically the bank account, it's down to about $96 billion. I looked at the website today as of Tuesday. And so once it gets raised, Treasury is going to sell at least $500 billion of Treasuries rather quickly. So it's going to spike and it's going to suck out a lot of liquidity. And I would have to believe that has a lot to do with the jump in interest rates over the last couple of days.
Okay. Could it be that people are going to have to learn that rates could go higher, not because of economic growth, but because of supply, and that you could have higher rates in a weak economy because of supply? Do you think that
and also stagflation?
Okay. Yeah, and inflation not giving up the ghost at the same time. So the bonds could be bad even though the economy is weak, because we just have to keep financing this. And it's not just here, it's everywhere, isn't it? There's just not enough. There's too much supply for demand to absorb in the global bond market, whether it's gilts or it's notes.
We had an epic bond bubble that was epically defined as a negative interest rates, which is the epitome of a bubble, where it's the ultimate hot potato. And when people ask me where do rates go, well, I argue, well, short rates are probably at peaked. But with the 10-year, I can make the argument that the 10-year goes to 4.5. But I can also argue that it goes to 2.5 to 3.
You're right.
The point being is that it would go to 2.5 to 3 in an economic recession and inflation continues to fall, but it goes to 4 to 4.5, not because growth accelerates or necessarily inflation does, which it could, but because of this continued bond bubble unwind and supply, and how does the Treasury market absorb QT, not just here, but also in Europe? How does the world's bond markets absorb when I believe the way that in Japan is going to widen yield curve control at some point in the next couple of months?
Why is their equity market melting up in a parabolic fashion, Peter?
Well, even with this, the Japanese topics is still about 25% below where it was in 1989.
Yeah, I know.
You have attractive valuations. You have rising returns on equity. You have appreciation for the changes in corporate governance. You have Japan is a big beneficiary of a China reopening, and what that means for growth in the Asian region, and why while the China reopening has really been mostly isolated to consumer spending on travel, leisure, hospitality, and so on. Well, pre-COVID, a quarter of, maybe it's up to even a third of Japan's tourists came from China. So if the Chinese start traveling again, Japan's going to be a beneficiary of that. And I think it's not just Japan. I mean, look at European markets this year. I mean, the Euro Stoxx 50 is up 15% this year. It's double the pace of the S&P. So it's not just Japan, but listen, we've had 10 years of dominance of US markets relative to everything else, mostly because of big cap tech. And while big cap tech is having, it's day in the sun again, because people can't give up the hope that these stocks will continue to dominate.
Am I crazy to be bearish Apple up here, Peter? I'm in set puts.
I mean, I think it's okay to be bearish on all these big cap tech companies. They're great companies, and AI is really exciting and everything. But yeah, I mean, Google search itself is AI. Therefore, AI has been going on for decades. And yes, this iteration is very exciting, but I think that the hype in the short term is going to overwhelm reality. And we've seen this movie before. For anybody that's been in the markets for many years, is when you get this sort of differentiation in markets, it doesn't always end the way you want it to, and it's not usually the laggards that catch up to the winners. It's usually the winners that catch up to the laggards. Because when you think about it, if let's take the S&P 500. If 7 stocks are doing great, 493 are not, well, who are the customers of those 7 stocks? It's the other 493. So you can't just keep buying the 7 stocks.
Great point.
When the 493 are your customers and they're seeing slower demand and slower business themselves.
Yeah. Okay. Hold on a second. Chat GPT isn't working. It's been sending me the questions for this interview. Oh, here's one. All right, it's working again, Peter. So Blake brought this up today. Any comment? He's talking about an alarming move in a managed currency. Any impressions on what's happening with China's or reopening? I know you thought that it was going to be a pretty strong reopening. Is copper and what the yuan is doing saying otherwise? That was it? It was, burst and it's petering out. Plus, you got some pretty bad data out of China this week.
The China reopening has been robust with respect to the consumer. You look at the Macau numbers; they're robust. They're almost back to where they were in 2019. Look at domestic travel. You look at restaurants. Yeah, it's robust. But copper, China manufacturing, Chinese exports is still subject to global activity, and copper demand is still subject to the Chinese residential real estate market, which is challenged anyway. So you have to sort of differentiate what's happening in China, but over time, when you liberate 17% of the world's population after 3 years of lockup, you're going to get a nice reopening, but it's not going to all happen at once. And again, China's manufacturing sector is still going to be dependent on demand from the U.S., demand from Europe, demand from other parts of the world.
Okay, interesting. You talk about what consumers are buying. That shows that there's concern about their personal liquidity. Yet when it comes to things like Memorial Day and travel, it's almost like we have two economies that even when people are broke, they're going to find a way to take that vacation, right?
Well,
They may not go out and buy things at the store, but they're going to spend money on the experience because of the lockup. People feel, I think it changed a lot of people's attitudes about the future. The future is now. People used to save for the future. Now the future is who knows what's going on. We were never thought we'd be locked down like that. Time is more important to me than money. I want to do what I want to do now. I'm not going to delay gratification.
well, it's that, and also it's the prioritization of what people want to spend their money on. And after spending a lot of money on a lot of things, goods wise, over the last couple of years, if I'm
Yeah,
not repeating that spending, well, then I have extra money to go out for dinner and go to a live concert, or go to a baseball game, or get on a plane and travel somewhere. So it's the prioritization, it's the shifting of spending habits. I think in the aggregate, uh, retail sales is definitely moderating. And as I said
yeah,
earlier, consumers are becoming more sort of discriminating and where they place their money in. But if I'm not buying a piece of furniture would have cost me $500 to $1,000, well then yeah, I got $150 to go see Bruce Springsteen if I can get a ticket like that. So we on Stock and Live Nation, and
yeah,
their quarter was pretty robust. And it's not just
right.
in the US, but the consumer feels like live entertainment is where they want to spend their bucks. And but that's just sort of a shifting thing. But I think in the aggregate, you can only push price so much. And it'll be interesting to see after the summer whether a lot of the leisure desires have been satiated, and then the consumer starts to retrench on everything. That we'll have to see.
Do you think the market is ignoring the fact that what happened in our banks is the problem is not the failure of those banks, but credit tightening conditions are going to be, really the fallout from it? And then I'm showing the TLT here, Peter. And, a few weeks ago, I thought we could break out over 109, but now we're threatening a breakdown here. Again, the supply deal. Isn't a new low or a new high in 20-year paper going to take down more banks? I
Well,
mean, if
just a couple of
they're going
things.
down, go ahead. I'm sorry.
No, go ahead. Finish up.
Because they're going down with the bonds really having stabilized for about 6 months. So another wave of selling in bonds that take yields to higher levels than they were last fall, I have to think is going to exacerbate what's already happening in the banking industry.
Well, a couple of things. I think what's keeping the stock market at these levels is, now granted, it's very bifurcated, as we talked about, with everything outside of the top 7 or 8 stocks doing poorly relative to the top ones. But there's also the attitude of, I don't want to miss the end of the Fed rate hike rally.
Okay.
How many people don't want to miss that rally? Oh, the Fed's done, I got to buy stocks.
Yeah.
I mean, it's about $1 for every time I heard that. But I think that's missing the reality that just because they're done hiking doesn't mean that they're quickly cutting, and that by leaving rates high for longer is a continued form of monetary tightening, and QT is still going on at a pretty hefty level. I think with respect to the banks, I think the Fed's program, that the lending program that they put in place, where you can pledge 80 cents of MBS and treasuries and borrow 100 cents back, even though that money has to be repaid in a year. I think that's relieved some of the duration risk on bank balance sheets. I think the biggest risk to banks is on the credit side, in that we see what's unusual about what's happened with the banks is, historically speaking, you go into an economic downturn, delinquencies rise, credit quality deteriorates, and that's what takes down a bank. This time around, it's been completely reversed. It was the widespread between deposit rates being paid and the risk-free rate in, call it a money market fund. At the same time, we've had this duration problem. This is even before a credit cycle occurring. So now we are on the cusp of a credit cycle. But I do think that the duration issue and the implicit deposit guarantee can at least contain bank failures for that catalyst, where the upcoming potential bank failures is going to be more of I've extended myself too much in commercial real estate, for example.
Yeah.
Now, that said, the historical loan to deposit ratio in the US banking system is about 70%. Now it's only about 60%. So it is possible that we don't have really, even on a credit down cycle, too many bank failures. To me, the more of the risk is just a general credit squeeze, which I think we're clearly in the midst of here.
Okay. Yep, that's a lifeblood for American business, right? The small, medium-sized business, regional banks. That was a symbiotic relationship that worked for a long time, and business lost that partner in the last several months, haven't they?
That's absolutely right. Someone who wants to open up a couple restaurants and borrows money, Goldman Sachs is not taking their call. The U.S. capital markets are not doing a bond deal for Joe Schmo barbecue restaurant in Middle America. You got to go to your local bank, and if you can't get it from your local bank, you're going to have to stump up for more equity. And that's what that's what we need. We're going to need more equity because there's going to be less access to debt. And after relying so much on debt over the many years and less on equity, it's going to have to be reversed.
Okay, well, CEOs have been depending on equity. That's why they buy their stock back. Right?
Yeah, well, they've done that a lot by borrowing money in the debt market to buy back
and then buying their
equity.
stock.
Right, but they're accessing the capital via the credit market as opposed to their cash flow. Now, some aren't obviously doing it through cash flow, but you get the point.
I think it's the first time in my career where I've seen sovereign bonds, which are supposed to be, treasuries, which are supposed to be the best of breed, if you compare to corporate and junk, holding up better than sovereigns. Is there a message in that?
Well, with respect to corporate credit, it depends on the duration of what we're looking at here. If you look at high yield, a lot of high yield is more shorter duration than investment grade. So investment grade has sort of traded with the U.S. Treasury market because of the historically high level of duration. So I think it's important to make that sort of distinction in duration levels. And then you have part of the corporate credit market, which is floating rate, which has actually benefited from the rise in short-term interest rates, even though credit quality is much weaker. I do think that the corporate credit cycle is what comes next in an economic downturn, but I think that's part of why it's held up. Also, getting back to the point I made about stocks is no one wants to miss the Fed is done rally, and that has also, I think, kept corporate credit spreads relatively tight to where you would think otherwise.
Do you ascribe to the statement that if I could get the dollar right, I could get everything right, all one market, dollar really driving it? I don't know, chicken, egg, yields, or dollar. Do you think that the move that started Friday over 102 has legs here, Peter, under current market conditions?
If we go back and look at what was the driver of the dollar, and I'm going to have a starting point of June 2021, it was all the Fed and expectations of how aggressive the Fed would be. June 2021, Jay Powell at the FOMC meeting said, we're now thinking about taper and QE. That is what lit the match under the dollar rally. And when did the dollar rally end? It ended at the end of October, just as the Fed ended their cadence of 4 meetings in a row of 75 basis point rate hikes. So it was solely tied to the aggressiveness of the Fed. And once they started to tail off in that aggressiveness, the dollar topped out. The only reason why the dollar's rallying here is because Fed speak over the past week or two has sort of raised the possibility again that maybe they need to hike again. I think they're done. I don't think they go in June, but I think that is what has helped the dollar rebound here, coincident with the 2-year getting back above 4%, now at 4.25%, because of that. But once I think we see that the Fed is not going to hike again, I think we'll head back down on the dollar.
Okay, so at best a bear market rally. I know some people are saying that we could, once we get through 103.5, that's going to squeeze it. Plus, you do have a lot of dollar bears right now, Peter. I mean, COT data. If we do get a dollar rally, it'll be the most hated dollar rally in a long time.
Yeah,
So,
I mean, you can say sentiment has gotten a little pushed here on the bearish side, but it's we also have to look at the dollar more than just against the yen and euro. I mean, a couple of days ago, the Mexican peso.
Yeah.
I mean, even with this little bounce here, I'm going back to
you're right.
2016, the last time the Mexican peso was this strong. So the dollar is pretty weak underneath the surface here.
Yeah, we used to make fun of the peso. I mean, there were all kinds of devaluations. Not, people. I can't remember the last good bull market in the peso.
Well, the peso is benefiting from hopes of supply chains diversifying to Mexico from other parts of the world.
Yeah. Okay. Maybe we should open an office down there, huh? Puerto Vallarta, Peter?
Or own some industrial real estate or some factories.
Okay. As long as I don't have to work on it.
No, you would just click
I'm
on
in.
it.
Okay, I'm in. So, I recommend everyone include this in their intelligence gathering, keep a tab on what's happening economically with Peter. Go to his book report, and you can find Peter on Twitter at Boockvar. Anything you want to close with, Peter? It's been great talking to you again.
That when the debt ceiling gets raised, to my point earlier, Treasury is going to sell hundreds of billions of dollars of treasuries. Treasury general account will jump up, and that could be a reversal of some of the easy liquidity we've seen as they've drawn down that facility. At the same time, the Feds will be doing QT, and their balance sheet will soon get below where it was right before SVB went down.
Are we going to take out the October low before we make a new high in the S&Ps, Peter? That's a pretty easy call. Okay. Do you think it's this year or next year?
I don't know.
Okay,
I would guess the latter part of this year.
Okay.
Would be my
negative
guess.
Fall. Okay.
Yeah.
All right, Peter. I really appreciate you coming here. I enjoy talking to you every time we're here. Because I could ask you anything, and appreciate your insights. Thank you.
Thanks, Dale. I appreciate having me.
All right, everyone. Peter Boockvar, and subscribe. It's free. He also has a paywall for his elite stuff, but pay attention to Peter, and when you see him on CNBC, turn up the volume. Okay.
Thanks.
All right, buddy.
Bye.
My trading warrior brother, Peter Boockvar, everyone. Have a great day trading. You could join the team in about 18 minutes on the morning edge. And don't just count your bips on the 10-year going to 395. Count your blessings. And I'll see everyone for TGIF tomorrow. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.